Alright troops, Mortgage Dad here, doing what I can to demystify the mortgage process to make things easier for you when you're buying that first house. No advice here, just information, just trying to arm you with all the details that you need when you're sitting in front of your broker or your bank or the internet trying to figure things out for yourself. So one of the most common issues or questions that people come up with at the very early stages of the process is just how the mortgage works. How's it structured? What does it do? What do I need to know? So this is covering off the basics. So your mortgage typically is going to be a loan secured on your house of 25 years. 25 years is the normal, the average term. It can be a term of anything up to 40 years. Some lenders will go as far as 40, some cap it at 35. But the kind of typical term is 25 years. And at the end of the day, who wants to have a mortgage for any longer than they absolutely have to? Although, that said, you will move house multiple times during your lifespan, so you're not going to be in the same house for 25 years. You're probably going to have 3, 4, 5 or more. So you're going to have a mortgage for 25 years. Let's say it's £100,000 that you're borrowing. Your mortgage works like a normal loan, where your monthly payment is paying off part of the capital that you've borrowed and the interest that's built up on that calendar month. Some lenders will charge their interest on a daily basis, some charge it on an annual basis. Daily is obviously better because the payment that you make will pay the mortgage off quicker than it does if your interest is charged annually, but that's not really something to worry about too much. At the end of the day, you just want to make sure that it's affordable and you get the house that you want, which is what this channel is all about. Now, you might have a 25-year term, but the interest rate that you pay will change during that time. Now, typically, you have two types of interest. You either have a fixed rate of interest or you'll have a variable rate. There's not so many variable rates on the go at the moment because things have been a wee bit kind of mental for the last few years. So we'll kind of park that for the time being. Fixed rates are probably the most common at the moment. Now, you won't get a fixed rate for the entire term of your mortgage. They don't exist. From time to time, lenders will bring out 25-year fixed rates, but they just are not popular whatsoever. Typically, a fixed rate is going to be 2, 3 or 5 years. What that means is that you pick a rate based on the rates that are available today, and you pay that interest rate for 2, 3 or 5 years, and regardless of what happens with the economy or the world, the politics, wars, Donald Trump, who knows, but your rate is not going to change. So that's good if rates are kind of volatile or going up, because your rate's going to stay the same. Not quite so good if rates are coming down, because your rate will not come down until the end of your fixed rate. But what you are paying for is peace of mind. What you need to think about is, do you want that peace of mind for 2, 3 or 5 years? The flip side of that is that you would then need to rearrange another fixed rate at the end of that period. So you're kind of beholden to what's happened during that time as to what rate you get. So it might be that well, say for example, you fixed your rate for 5 years in 2021 when rates were really, really low. Your rate will be expiring this year, and your rate will be potentially doubling because things have happened in between times that have influenced banks' interest rates and kind of driven fixed rates up the way. Equally, if you'd fixed it 2 years ago and you're looking to renew this year, then you're potentially going to get a bit of a saving. So you've got a gamble that you need to consider in terms of how long you want to fix the rate. There's no way of predicting what's going to happen during the time you're fixed into that rate. You just got to kind of suck it up when it comes to the end. So your fixed rate will give you that little bit of peace of mind. A variable rate, on the other hand, will potentially save you money if rates are dropping. Your variable rate will either be linked to the Bank of England's base rate, or it will be linked to the lender's own standard variable rate. The standard variable rate is just their kind of benchmark, bog standard rate. The theory is that any time interest rates change, your rate will change in line with it. That means they can go up, means they can come down. There's no guarantees with a rate that's linked to the standard variable rate. You're relying on the bank passing that reduction onto you if it happens, whether they do it in full or in part or not at all. If your rate's linked to the Bank of England base rate, then you've got a guarantee that your rate will come down or go up in line with the Bank of England base rate. So currently, when rates are kind of coming down, a variable rate, whether it's a tracker rate, which are the ones linked to the Bank of England, or a discount rate, which are the ones linked to the standard variable rate, might be a bit of a saving for you. What you've got to do is weigh up, do you want that risk in return for a small saving, or would you rather fix your rate for 2, 3 or 5 years and just not have to worry about it at all? At the end of the time that you're tied into, that's the other thing to factor in. If you go for a fixed rate, or a variable rate for that matter, you won't be able to move lender or move rate within the time that you're tied in without paying some sort of a penalty. Fixed rates, for example, will have an early redemption penalty of anything from 2% of the loan amount up to maybe 5%, depending on the lender. So basically means that if you decided to move house or sell up, or you just found that you'd fixed into a rate that is too high for you, and there's better rates available, you're going to need to pay a fee to get away from that lender or that rate. Once you come to the end of the period that you're tied into, you're completely free to do whatever you want to do. You can either stay with the existing lender, in which case they'll offer you an existing customer deal, and you just pick the rate that applies to you or that suits you best, and then that'll transfer over. Nice and simple. At that point, you could also look at moving the mortgage to a different lender, and that's called a remortgage. So you would basically just compare what your existing lender's offering you and what's available on the open market. If you can get something that's better on the open market, then you could move your mortgage to another lender to get the best deal that's available for you. And that, in a nutshell, is how your mortgage works. If you decided to move during the term, again, you've got the choice. You could stay with your existing lender, particularly if you're midway through a fixed rate. You might not want to pay that redemption penalty, and it's better to stay with the lender. And they offer a facility called porting, which basically means you can carry your mortgage to the new house and you don't pay that redemption penalty. You might need to top up the mortgage with whatever rates they have available at the time, but it would save you paying that redemption penalty fee. But other than that, it's pretty straightforward. You're just tying yourself to the bank for 25 years. Good luck.